Hi, I'm Ron Verostek of Verostek Tax and Financial. Today's presentation is the economics of elderly care. There's a lot going on about long-term care, and there are other alternatives such as short-term care and a couple others that we're going to show you because it has become such a major problem, and it's going to become even a more major problem as more and more baby boomers get older and older. I'm a numbers cruncher. I started the tax and financial business way back in 1980. And so that's what I do. I work with numbers. And when numbers don't start matching up, I start worrying about exactly which numbers are true and which numbers aren't. Now, they say numbers never lie, which is true. On the other hand, people can manipulate numbers to show you what they want to show you or get you to believe what they want you to believe. And so that's where a lot of the problem comes in with long-term care, in that the numbers don't always add up, and we're going to show you that. So it says that there's about 70% of the people over the age of 65 will eventually need long-term care sometime in their lifetime. And that was published by the Administration on Aging. Another one under Consumer Affairs, they did a report and they said 56% of those over 65 will need long-term care sometime in their lifetime. Well, as you can tell, there's quite a difference between 56% and 70%. And to tell the honest truth, I have a bit of a hard time believing almost either one of those numbers. Because like I said, the numbers just don't add up. We have over 700 clients, and I could guarantee you 30% of them are not, needing long-term care, even the older clients that we have. So I have problems with these. So I kept digging for more statistics, because once I could find numbers that start fitting together and agreeing with each other, then those are numbers that I feel that we can actually start to count on. So the other statistics that I found along the way are these. Once again, by the Administration of Aging, and this one's a little bit funny almost in a certain sort of way. It says the average length of time is 2.9 years. Later on, in some of their other material that they've published, you can actually find where it says 3.2 years. Well, that's a bit of a difference. That's about 6 months worth of difference between those two. And so right there, they're kind of contradicting themselves. And if you look at some of the other statistics, it gets much harder to even believe those. So your average cost by Consumer Affairs, your average cost for your total long-term care needs is only $138,000. Well, we all know there's no way you're going to get 3 years of long-term care for only $138,000, not when nursing homes run about $80,000 or $90,000 a year. So, those numbers don't fit. And then by the Department of Human Services, they say the average stay in a nursing home or skilled nursing facility, the average stay is 485 days. Well, 485 days is nowhere near 3 years, right? As a matter of fact, it's not even half of that year, of that amount of time. So then the other statistic I found was the National Center for Health Statistics, and that one says 43% of all the people who go into a skilled nursing center or a long-term care center is less than 100 days. 43% are less than 100 days. So the one number that I did find that almost everybody does agree on is that average cost per month at about $9,000 a month. And that one's a little open. I mean, it ranges from about 7,800 to a little over 9,000. And that makes sense because different facilities are of a different level. And also just by zip code, by counties, by states, things are going to change around a little bit. And so that one I can live with. But what's interesting is that's when the numbers start coming together. Because if you divide that $9,000 of average cost per month into the average cost of your total stays or total long-term care needs of 138,000, you come up with about 15 months. Well, if you take your average stay, the 485 days, and divide that by 30 days, you come up with about 16 months. So now these numbers are starting to come together. If we get rid of the first ones of the 70%, we get rid of the average length of time of 3 years, basically. all of a sudden the rest of the numbers are starting to match with each other, even though they are coming from several different sources. So why is there such a big difference between, 70% and 43% and all of those? A lot of it has to do with the definitions. Many call any kind of elderly care long-term care, such as at-home care. Could it be long-term care? Yes. Could it also not be long-term care, but still elderly care? Yes. Adult daycare, the same thing. It could go either way. Assisted living almost for sure is not long-term care. It is elderly care. And so, like I said, it's the definitions that cause the difference. So your skilled nursing care absolutely is long-term care. So it's the variables that make it all so confusing. The medical versus mental. So the reason why you go into a long-term care or skilled nursing care facility in the first place has a lot to do with how long your stay is going to be or average. So medical stays are more like for broken hips or knee replacements or things along those lines. And so people are usually in for a short period of time, less than 100 days. Whereas the mental type, so Alzheimer's or dementia, those could go on for years and years and years, up to 9, 10, 12 years. And so that's what really skews the numbers is you have a whole lot of people, half the people under 6 months, because there's another statistic that I didn't show you that said 47% of all people are out within 6 months, one way or the other. So you have all of those people, half of them there, but then the other half goes many, many years, 7 years, 9 years, 10 years. And that's what takes that average up to 3 years. Okay, so we have recuperation versus ongoing care. Recuperation is short, ongoing care is long. And then, of course, it comes down again to who is or who can perform the tasks that are needed. So a lot of the tasks, if it's a nurse that is needed to be there, then that's going to qualify more as long-term care. Whereas if you just need help with preparing meals or house cleaning or a couple things along those lines, then that still elderly care. We still need that help, but it's not what they normally call long-term care. When we bring all the statistics together, we end up with the fact that we actually have closer to a 50-50 chance of needing actual long-term care. And then we have about 50-50 chance that we would need help for more than a year. So when we're planning, I think it's important to keep these numbers inside of our heads. It really comes down in the end to about 25% chance that somebody would need long-term care for more than a year. So it gets smaller and smaller. Now, where things get a little bit on the ugly side is that 61% of people in skilled care facilities, nursing homes right now, actually qualify for nursing home benefits by needing the help with 3 or more ADLs. Now, you're going to see here in a second, ADLs, activities of daily living. You have to need 2 or more of the 6 to qualify for long-term care benefits. Well, as it's showing here, 61% of the people do qualify with 3 or more, but that means 40% of the people are in nursing homes needing help, but not enough to where it would actually trigger a long-term care benefit. So as you could probably tell by now, I'm not real fond of long-term care insurances, and we'll see why here in just a second. So, and this is the old solution, the long-term care policies. They're terribly expensive, thousands of dollars per year that you'll pay into them. And yet they're very hard to collect on because of those ADL rules, the activities of daily living, which we'll cover in just a second. So then the basic policies are so expensive that people can't afford to add on the refund feature. And don't let that word refund fool you. Refund doesn't mean all of your money back. It usually means more like half of your premiums back if you never use it for activity of daily living. But that's going to add another 30 to 40% on the price of it, which is already prohibitively expensive for most people. So the final result is, are you lucky or are you unlucky or are you really unlucky? Lucky, if you're lucky enough to be healthy enough to buy a long-term care policy because the underwriting is fairly tough, there's a good chance that the policy will never pay you back because you're also lucky enough to be healthy enough to where you would never need it. And so many times long-term care policies are basically use it or lose it type propositions. If you're unlucky, well, it means that, okay, You were lucky enough to buy the policy, but you're unlucky enough to where you actually have to collect on the policy and you're stuck in a nursing home for a while. If you're really, really unlucky, it means you ended up in a nursing home, you have a policy, but you're not bad enough off to where you can collect on the benefits of that policy. So the magic wand is those ADLs. We mentioned them a couple times already, the activities of daily living. You have to not be able to do two of the six activities of daily living in order to qualify for the long-term care benefits off of a policy. Those six activities are eating, bathing, dressing, grooming, mobility, and toileting. And they are tough. They're really tough. If you decide to try to collect on a long-term care policy, they will send over basically an investigator and they will go through these steps to see if you're able to do these things or not. And like I said, they're pretty tough. We had one case, one lady, and so the second one that we were going after was the bathing, and they were actually denying her because they were saying that, well, she could put on pants and slacks and pants and a blouse or a shirt. But what she couldn't do is she couldn't put on socks and shoes. She couldn't bend over far enough to do that. And so I argued with the company. I said, hey, we're in Colorado. In Colorado, it's kind of important that you wear socks and shoes at least good 6 to 9 months of the year. And so eventually they gave in and they did end up paying for a couple of months, but only a couple of months because soon after that she did pass away. So that was on the dressing one. I'm sorry, I might have said bathing, but that was on the dressing one. The other one was a bathing one. That was the second thing we were trying to get done. And they said, no, you have safety bars in the showers and she can step in and out okay, so she's good. But she had already fallen a couple of times just because too slippery and she wasn't strong enough to necessarily hold herself up. So the family said, no, we don't want her, taking showers by herself. We need somebody there when that happens. So once again, we had to argue with the company. Eventually, they did agree. But then once again, within a couple of months, the lady had passed away. So in both cases, the ladies had paid in tens of thousands of dollars into their policies. And by the time we actually finally got them to pay for any of it, they only paid out for a couple of months. So tens of thousands in, somewhere between $8,000 and $10,000 out, and the rest of it was lost forever. So some people go, well, we'll just let Medicare and Medicaid take care of things for us. Well, the rules with Medicare are they will pay for days 1 through 20, but only if you had spent 3 days in the hospital for the same reason prior to going into the nursing home or skilled nursing care facility. And they mean a full 3 days. The day that they let you out does not count as a day. You need to be in there a full 72 hours for it to count as 3 days. And then after that, so then if you have Medicare supplement, they might pay all the way up through 100 days, but only if you're improving. So let's say you had a stroke and you're improving. And so that, we're on day 30 or 40 and fine and dandy, they'll keep paying it. But come day 40 or whatever, all of a sudden you hit a plateau and you're not improving anymore, they quit paying. That's the end of it. Now, on the Medicare Advantage programs for days 20 through 100, you have a copayment of $204 a day, which, that's for 80 days. So that's $16,000, just so you know, it's out there. Okay. And that's going to be important because one of the solutions we're going to show you specifically talks about that issue. So then your other choice is Medicaid. But with Medicaid, you have your spend down rules. You have to have liquid assets of less than $2,000 before they will come in and help pay for your long-term care. And if that money, they go back and they look to see what you did with your money. They're going to look back over 5 years. So if you gave Johnny $10 for his birthday, they're not going to say anything about it. You gave somebody $1,000 or more, they're going to want that money to come back into the estate and pay for nursing home facilities before you can even apply for it. So if you apply for it and they find out, oh no, you gave away, $2,000 to somewhere, and they don't like that, then they stop your application right then and there. It's basically thrown out. They tell you you have to pull in that $2,000, you have to spend it on long-term care, and then you can reapply after all of that's been done, which by then it's a little too late because now the bills are racking up and you get the message. So they'll also put liens on the housing. So if you're the last one left of a couple, then once you pass away, they're going to sell the house, pay themselves back, and then pass on the rest of the money back to the rest of the family. If you are still married when you pass away, then your spouse does get to keep the house for as long as they live and stay in that house. But once again, once they pass away, then Medicaid will sell the house and get their money back and then pass the rest on to your beneficiaries again. So there are some modern day solutions, and that's what we're going to cover. This is just telling you what those solutions are. There's been a couple bright ideas, hence the picture. So we're going to talk a little bit about a skilled nursing rider on indemnity policies. We're going to talk about short-term care policies. I know it says car there. That's the one mistake we left in here because when we do these live, we make that a contest to see who sees it first. Then we have annuities with long-term care riders, and we have life insurance that can be used as a long-term care coverage. So let's talk about the first one, the skilled nursing facility on an indemnity policy. So indemnity policies are little hospital indemnity policies. So it says if you go in the hospital, we will pay you so many dollars a day for so many days. And you get to choose how many dollars a day and for how many days. And that controls the cost a lot. You have to have at least a minimum policy, and a minimum indemnity policy is $100 a day for 3 days. Now, a lot of Medicare Advantage programs, your hospital copay is $325 or $225 a day for 5 or 6 days. So a lot of times we'll match that just so that it gets rid of that hospital copay for you. And they're very inexpensive. The $100 a day for 3 days is like $8 or $9 a month. So you have to have one of those in order to attach the skilled nursing facility rider onto it. Okay. The good news is people automatically qualify for it. If you're under the age of 80 and you want one of these, you can buy one of these. Now, there is a 6-month pre-existing condition, so you can't go in the hospital and or nursing home within in the first 6 months for something that already pre-existed. Now, if you fell and broke your hip, that's obviously not a pre-existing condition. You're fine and dandy. You're covered from day one. Okay. This one, on these low policies, you do not need to do the 2 out of 6 ADLs. They don't worry about that at all. But you do. It does require the 3-day hospital stay, like Medicare does. Sorry. So long as you've had your 3-day hospital stay, then they will cover up to 50 days, up to $200 per day. So just a sample price for a 70-year-old male, $200 per day for 50 days. And this is with the indemnity rider also attached to it. The whole thing is only $21.33 a month. So that's a $10,000 benefit. And I like these because this one is the one that stands the best chance of us actually ever collecting on a long-term care or short-term care policy. As we were saying with all the other statistics, 43% of the people are under 100 days. Well, if we get 20 by Medicare and we get 50 here, that's 70 days. That's starting to add up pretty good, and we can definitely put a dent in it, and for a very low cost or fee. Second thing we want to talk about are short-term care policies. So everybody's heard of long-term care policies, and they usually pay for a year, 3 years, 5 years, or longer, although those are hard to come by. And just for the record, another quick statistic, 70% of all the companies that have ever sold long-term care policies no longer sell them. It's gotten harder and harder to get them, and harder to get a good policy for that matter. So the short-term care policies are 1 year or less. So you could buy a 30-day, you could buy a 60-day, 180-day, 270, 360, whatever you want, but that's the longest you can buy is the 360, 365 days. So it's very short term, but once again, the other statistic was 47% of the people are out within the first 6 months. So, you might want to look at even just like a 6-month policy. So These do have the same restrictions. Now we're back to you cannot perform 2 out of the 6 ADLs in order to qualify to get the benefits. So it is kind of a mostly use it or lose it proposition again. They do have a refund feature, but once again, that's going to cost you an extra 30 to 40% more in your premium. And it's also going to not give you all your money back. It's only going to give you half your money back. And that's only if you've paid into the policy for at least 20 years. If you paid for less than that, the refund is less than that. The underwriting, on the other hand, is much more lenient on these than it is on the long-term care policies. So that's good news. A lot more people could qualify for these than they would under the long-term care. So a sample, $200 a day. And well, I did here again, 70-year-old male, $200 a day. And these are actually built to where they're at-home policies. So they, if you're going to use this, just use the benefits, but stay at home. That's one part of the policy. The other part of the policy is the long-term care in a skilled nursing facility. You can buy one or both together. So if you wanted a $200 a day benefit and just for care to come in and help you at home, then that's about $70 a month. If you wanted a $200 a day benefit, which is $6,000 a month, you want a $200 a day benefit for a nursing home or skilled nursing facility, that's going to run you $137 a month. If you want both, you put those two together and it comes out to $207 a month. And that's for a 180-day policy, by the way, is what I did for that sample, which is the 6 months. So just so you know, you could do the at home for as little as $100 a day. You could do the long-term care in a facility for as much as $500 a day, although I would never suggest more than 3 at the moment, because 3 times 3,000 a day for 30 days is 9,000. That should be enough to cover you. So it's a good solution compared to the long-term care because it's much more affordable and it's easier to qualify for these. It's not the best solution, but it's a solution and could be a fairly good solution for many people. So then the next thing we want to talk about is there was a new law passed called the Pension Protection Act of 2006. I know. Why did it take so long for us to actually learn about it and start using it? And Section 844 deals with annuities, long-term care, and the tax advantages. The act allows people to convert tax-deferred savings into tax-free earnings when spent on long-term care. So in the old days, or right now, how we normally do it is you have an annuity, you cash in your annuity to pay for long-term care, and let's say you brought in $40,000 of taxable income. And so you're going to write this off and you have $40,000 of expenses. So you bring in the $40,000 of income and then your $40,000 of expenses. The problem with that is you could have had 13,000 of that anyway, because that's just your standard deduction. So your 40,000 benefit just turned into a $27,000 benefit. But then also because medical expenses, you have to exceed 7.5% of your income before any medical expenses count. So 7.5% of 40,000, we're talking another $3,000. So now our $27,000 write-off just turned into a $24,000 write-off. So we brought in 40, but we're only getting the benefit of a $24,000 write-off. If your money was coming out of these long-term care qualified annuities, then that whole thing would come in tax-free. You wouldn't have to go through any of the rest of the mess of trying to do the itemized deductions or any of that. You would still get your standard itemized deduction and you would get the 40,000 in tax-free. So it took a while for the insurance companies and the industry to come up with a product that would work according to the 2006 tax law. But they did finally develop an annuity with a long-term care rider. So you get long-term care protection and you get most, if not all of your money back. In some cases, you even get more than your money back. So how is this working exactly? Okay, you put aside some money and later on, if you need long-term care, you get back up to 3 times that amount of money. That's what the rider will do for you. If you don't ever need the long-term care, you will get most or all, or many times more money than what you actually put into it. That mostly depends on choices you make when you first put the money away. So becomes your choice. You have an annuity and you focus either on the growth or you focus on the long-term care benefit. If you focus on the long-term care benefit and you qualify, there is some qualification here. Anybody could buy one of these, but it depends on how much benefit you get as to your health situation to a certain extent and how much you want to go towards the long-term care versus the growth. So these are built These are built on what is called an indexed annuity. An indexed annuity makes money when the market goes up, but does not lose money when the market goes down. I'll do a whole nother video just on that, mechanics of that and of how that works. Now, if the market goes up 20%, you don't get 20%. You're going to get more like 8, um, depending on the contracts. So there's a cap as to how much you can make. But there's also a cap on how much you can lose, which is nothing. You can't lose any of it, as far as the indexed annuity in itself is concerned. Now, because there are fees for the long-term care, could your account go down a little bit in a given year? Yes, but only by the amount of the fees for the long-term care. You would not lose any of the actual value of the money like you would in, say, the stock market or a mutual fund or ETF or something along those lines. So what happens is you buy this annuity, and then off of the earnings of the annuity, they use part of the earnings to buy the coverage for the long-term care. And like I said, you could do anywhere between 100% and 307%. So after the fifth year, if you put $50,000 in, come year 5 or later, your minimum benefit coming back out for long-term care is going to be 150,000, and that keeps growing. The longer it's in there, the bigger that gets. If you put 100,000 in at 307%, you're going to have a minimum of 307,000 after year 5, and it keeps growing on and on after that. So one of the things, the other statistic that I didn't tell you yet, is that the average age is in the mid 80s when people need long-term care. So if you put money away when you're 70, 75, or even in the 60s, it gives that money a lot of time to grow. And those policies, I can't show you on here because I don't have enough time on this webcast. But we show where 100,000 becomes $4 or almost $500,000 worth of long-term care benefit. Or if you never need it as long-term care benefit, it goes back to the cash value. Now, the cash value in that case is not going to be 4 or 500,000. It's going to be more like 200 to 250, but still that's good considering what you put in and the protection you're getting. So how the money comes out, is it going to come out tax deferred or tax free? Depends on that payout. Like I said, if you get to 90, you still haven't used it for long-term care and you don't think you're going to, and you get diagnosed with, you got 3 months to live, you're more than happy to cash that out. And in that case, then the growth is taxable. It grew tax deferred, but the growth is taxable. If your kids or somebody else inherits the money, then of course they're also going to have to pay taxes on the growth. On the other hand, if it did get used for long-term care expenses, that money is going to come out totally tax-free. So one of the neat things that we can do now is we can transform old annuities into the new long-term care qualified annuities. We could take advantage of that Pension Protection Act of 2006. Lots of people are sitting on old annuities with huge amounts of growth in them, 30, 40, 50, $100,000 worth of growth inside their annuity. And they're kind of afraid to take it out, and they really don't need to take it out. So they just let it keep growing because they don't want to pay all those taxes. Well, we can convert it with what's called a 1035 exchange, and we roll the old into one of the new long-term care qualified annuities. And now you have all that extra added protection, and you have a good chance, or at least you have a chance, in getting all that money out tax-free someday. So the last option is the life insurance. There are now a couple of life insurance products that double up as long-term care products. You can use the face value as a long-term care benefit. Those are paid out over 2 years. Oh yeah, back on the annuities just for a second. Those are paid out over 5 years. So the life insurance is paid out over 2 years. So if you had $100,000 face value, you're going to get $50,000 a year. I did a $7,000 a month benefit, and that works out to be about 168,000. The reason I did is I wanted to see how the payments stack up against the benefit. So if you're going to do one of these, you want to do either a single pay or a 10 pay at the most. You do not want to do a pay till age 95. You'll end up paying more than you'll ever get out of it. So a single pay, like I said, $7,000 um, a month for 2 years equals about $168,000. So if on a single pay, you would put about $130,000 in, depending on age, of course, and health and all those other things. But just generally speaking, you're going to put in about $130,000 for a $168,000 benefit, but it all comes out tax-free. And like I said, if you don't use it for nursing home, you get the entire amount, the whole 168, as a life insurance benefit, also tax-free. So if you do a 10 pay, you're going to pay in about $167,000 to get $168,000 out someday. Paid in the 95, you'll pay more in than you'll get out of it. So that's a product that I just wanted you to know that is out there so you can at least get your money back. It's not my favorite, and it's probably not necessarily the best one for you, but it is out there. I wanted you to be aware that it's out there. So it's your choice. Your choice is this. You can either take money out of your income every month for a very long time and possibly never get any of it back, because the long-term care or even the short-term care policies are basically use it or lose it. If you never use it, you're never getting that money back. Or you can just reposition some of your assets. So we have a box of assets, and we're just going to take out a little bit out of that box. We're going to take out the right bottom corner. We're going to take that out, move it over to another place, such as the indexed annuity, and let the earnings off of that pay for the long-term care benefit. And then if we never use it, that bottom section of the box comes right back into the box and goes back to either you or to your beneficiaries. If we do use it, well, then we have it there to be used, and we got 3 times our amount or 2 times our amount compared to what we put away. Plus we got the deferred growth. And so we get that. And if we use part of it, the rest of it still comes back into the box and goes back to your beneficiaries. If we use all of it, okay, well, that was the whole plan to start with, and everything is still intact. So that's how we do things. We all have this problem. As we get older, we all have this problem. We're all worried about what if, right? And so we have the puzzle, and now I've given you a few options about that missing piece of the puzzle and how to fix it. Like I said, many people worry about it. The government even worries about it. That's why they came up with that 2006 law. It's because they know how many people are going to need long-term care. Now, like I said at the beginning, do I believe in all their numbers? No. Do I believe we have about 50-50 chance? Yes. Do I believe we have about 50-50 chance that will be a year or less? Also, yes. And so that's why I've showed you these options that basically cover those issues at a much lower price, or even a way to pay for it and get your money back in the end. So if you would like to work through this, or if you would like quotations, illustrations, something along those lines, please give me a call. I'm a licensed agent in Colorado and a few other states, and I would be glad to discuss this with you and to run illustrations for you and take this a little bit further. Our phone number is 303-776-0867. Once again, that phone number is 303-776-0867. I'm Ron Verostic. I'm the author of Financially Intact, and I'd be glad to help you if you want. Thank you for listening and watching, and I wish you the best in everything. Thank you.